All right, folks, welcome back. This is our midweek review for the ICT Mentorship. Wednesday, September 29th, 2021. All right, a little bit of housekeeping real quick. So obviously last night I gave you a very long bit of a rant and kind of like aired out some things. And I got a lot of questions over the past couple months, and some of them were like, hey, can you stop beating around the bush? Can you just talk plainly? Where do you stand with this? What do you see? What do you think? Right or wrong? And that's what I shared last night. Some individuals obviously emailed and said that they're no longer interested in being here because of my views. And to that, I wish you farewell and adieu. Okay, because I did not tell you I was going to come here and tell you your ideology is going to be supported by me. I'm an independent thinker. I am going to be against the grain. I said this in the beginning before any of you enrolled. And a lot of you that have been with me for a long time know that I have always been against the grain. So I don't want anyone's misunderstandings get in the way of why you really joined here. So if you're leaving, I wish you the best. Just remember, once that door closes, it doesn't reopen. And with that, let's continue on into the dollar index. Here is the daily chart. And I mistakenly stated to look at the weekly high. If I'm not mistaken, last night in the recording, I said you go back and look in your weekly high. I misspoke, and it's this high here. This is those relative equal highs. I know they don't look all that relatively close, but it's the low resistance liquidity run signature with the lower high here. This is the high I was referring to. If you go back and look at your notes, this is in fact the level you'll see in your notes. Second bit of business I forgot to mention. I have people asking, where is the video from Monday? And others reported that I mistakenly put Monday in the post in your forum. I'm going to be changing that. The video itself will not change, but just the description, so that way I'm not getting a lot of flack from my staff saying, hey, look, they're saying you messed up and put the wrong day name in yesterday's post. Yesterday's post was the only video for this week so far. Again, I did not do a video for Monday, but because I had Monday on my mind, I put Monday in the post. And once I created that post, what I do is I copy that general description and then I paste it, and then I change the link to the respective user groups for those individuals that are being monitored. So long story short, I will correct that today, but the video will not change. But there is no video per se for Monday. And I mentioned this last week, and I said it in the video on Friday, and I also posted it on Friday's description saying that there would be no video on Monday. Okay, so again, this is the reason why you should be writing things down instead of just listening and waiting for things you want to hear. Okay, so I do my best to try to bring you up to speed and warn you ahead of time if there's going to be some changes or additions or omissions from what I normally do in terms of delivery of content and lessons. So it's beneficial for not only yourself staying informed, but also trying not to burden the staff with emails that are just needless, because it's this silly oversight on your part that didn't see things that was mentioned last week. Okay, so again, no video per se on the Monday, but I'm going to change everyone's post because I did it with every single user group. I put Monday in yesterday's description of the video. Obviously, it was Tuesday's data, Tuesday's analysis and all that, but I'm being a dead horse now, I know. But some of you just don't want to pay attention close enough, and I'm trying to make sure I'm covering all bases now and explaining why there will be an edit in yesterday's post. Okay, so that's that. Now we're looking at the dollar index, the daily chart. We got a nice delivery up above this old high here, and if we continue, we're looking for a run into this high back here. All right, so it's been nice to see it run from this imbalance here The outside day was a down close, and then true to form, you can thank Larry Williams for that pattern, because otherwise I would have never known it. The idea is obviously shown with a beautiful display of running on buy side here and buy side here. Now, does it have enough momentum to carry us up into here? I'd like to think that it will, but do we require a down day on the daily chart? Does it need to come all the way back down in here? No. A lot of support and resistance folks are going to be hoping that it can come back down here, hit this as a support level, and then maybe run for this old resistance level. I don't want to see that. I want to see maybe a down. I don't want to see a reverse and cover back over top of this buy side balance, sell side inefficiency that's really extended. This with a down close and then continuation up the very next day or on Monday, that's favorable. I don't want to see it come all the way back down and cover all this up, okay? All right, the hourly chart. You can see we ran right from Jump Street, turn of the new day, New York, midnight. Just rammed it right up into buy side liquidity. Just a wonderful delivery of price where it's just literally moving from an obvious level we've been watching and to a level of buy side liquidity. Now, for folks in here that get a little anxious or perturbed by periods when I am human and I have periods of uncertainty, lack of clarity from the algorithm, it's not telling me what I need to see, or I just don't trust the analysis, or I'm off, I'm just wrong. That is a small span of time, and over the course of your development and your long career, they will be short periods for you as well. And you have to keep the focus on the fact that they're temporary and you're waiting for more information. And we've seen that here just recently, where I needed more information. I didn't know what was likely to occur. I was wrong on one thing, and then I was able to get in sync with the marketplace, and then here we are. So that's a normal ebb and flow of developmental curve and or experience the difficulties that will plague you in reality, and then the short-lived difficulty, and then the return back to everything works like it's supposed to. I get so many people, and I was popped in my Telegram channel today and posted, obviously, the video I put on my YouTube channel today. And they came at me with maybe half a dozen folks, hey, do you think that they're going to change the algorithm? I'm so tired of answering that question. Okay, I'm so tired of it. And when people have a lack of understanding of what it is that you're learning here, and they think that it's in every single day, pinpoint accuracy, it's like I'm able to see every single thing every single day. And I don't. And I've been very honest, not only with you all here, but even the folks outside the mentorship. I do lose, I do miss opportunities, and sometimes I just don't know what it's going to do. And when I don't know what I'm expected to see in price, am I in a hurry to get in there? No. I'm very, very careful. So hopefully the folks that have just joined in the 2021 group that did not have the experience like the folks prior to you all joining, they have been through this with me, where there's a small number of times where for a very small segment of time, I don't know what to anticipate, and I'm waiting for more information. And then once the information is made available by price action, then we can get in sync with the algorithm. Now you have another example of that. So it's reality. It's gonna hit you. It's gonna hit you multiple times throughout your career, and there's no reason for you to doubt that the algorithm is broken, that they're changing it, that it's no longer effective, or that your model's broken, or my model's broken, or the things I teach are broken or flawed. It's just reality, folks. No one knows every single thing that's going to happen in price. They aren't going to be able to do that. I'm not able to do it, and I'm very, very informed. So it's important for you to understand when I'm teaching you, we're in low probability conditions. That means be very, very careful. But when I say, like I said last week, I feel confident, I think we're going to be moving towards these levels, and then bang, like gangbusters, we're back in business again. It does not mean that we won't go into another period of waiting for more information. In fact, with the British pound, as we'll get into that, we're fastly approaching that. Okay, so for now, we're going to continue with the bias on the dollar until proven incorrect. Dollar index on the 15-minute time frame. Again, you can see how we worked off that old high here. Rammed up. Institutional order flow entry drill. Expansion. Buy side liquidity. Just a real nice run up right into buy side liquidity. I love seeing that. Now the problem with this is many of you want to see a lot of the signatures that will appear. Now, when you get into grading price swings, if you haven't already gotten to that, I can't recall exactly where I had that lesson in the core content, but in the latter stages of a price swing, you won't get a lot of retracements. In fact, you won't get any stop runs, and you'll very, very likely see just straight runs into the premium array if it's bullish. And this is classic what I was describing when I taught in the core content the lessons around grading price swings. The midpoint move to the target, you will have generally some kind of a retracement and maybe even a stop run. The latter stages of the run tends to create and behave just like this, where it just keeps on running, and doesn't give the folks that are trying to get on board any measurable retracement, because they're all looking for some kind of oversold condition or bullish divergence to get in sync with this. And the algorithm knows that the retail crowd will think that way. So it's designed to just run aggressive. And that's why that latter stages of the moves into a target tend to be parabolic. Now, that's not to say this is a parabolic move, but this is a lot more one directional and just very little retracements versus like this here, up and down, sideways, up, down, back, lot of retracements, then consolidation. Then you have this, whoosh, right up to the buy side liquidity. So this is a signature you need to understand. If you know what you're looking for from a higher time frame perspective, and we're getting into these upper level targets, well, this is classic right here. You're not going to see a lot of retracements. You're not going to see a lot of, if at all, stop losses being taken. They're just going to just run it right on up into the target because they want to see those targets met quickly. So the algorithm is designed to deliver much more efficiently and quicker. Okay, the signatures that I'm trying to highlight here is the fact that we're seeing one-sidedness, where it just goes straight on up, very little retracements, no stop runs, and just right away delivery. Okay, so the algorithm is designed to do that. And that's a time and price element, which is important. All right, Eurodollar daily chart. And this is driving me nuts here because I screen captured before this went away. I'm just not going to redo the video. I can't do it. Even though my mind's saying stop, redo all this all over again, just please ignore this because it's driving me nuts personally. But we'll zoom in, take a look at this. But the imbalance, buy side imbalance, sell side inefficiency there in the form of this fair value gap. If we get some continuation and acceleration below these relative equal lows, which we finally got to, folks. We finally got there. We delivered. You saw that I actually went back in again this week and took a one shot, one kill there using the same account. And we went right to our target. Now, I did want to draw attention to this in the YouTube video. So it was basically framed on this in that video and maybe getting to this low here. But I didn't want to draw too much attention to that. But you all know what we were looking for here. But if we continue, I'm not saying it should be a straight drop like cable has. It can, but don't be surprised if we have to have an up close day in here. Okay, so that's permissible. It's expected. It's reasonable to see something like that. I don't see it as bullish. I don't see this as a triple bottom, like 1, 2, 3, and then go straight up. I don't see that at all. I'm expecting it to try to work towards this imbalance down here, the premium high, consequent encroachment, and then the discount low of this imbalance right there. All right, so let's zoom in here, get a little bit better view on this. So we had our imbalance here, we returned back up into. And I mentioned how this was like an SMT divergence. Go back into your notes, you'll see what I refer to there. And then the market accelerates down through sell side liquidity here, sell side liquidity on this old low, and there. So we're looking for, again, maybe an up close day. It doesn't need to be a big range day. I prefer it to be a small range day. But going back up into this a little bit is reasonable. And then accelerate and work towards this area down in here would be expected, at least in the general momentum that we're seeing now, and if we get continued upside on dollar. Euro dollar hourly chart. Okay, you can see how we worked on these levels here. And just, again, the same principle I mentioned when we were referring to the dollar index. One-sidedness. We had a little bit of a rebalance in here. Breaks down. Then we have this candle open. Immediate rebalance back to the previous low with this one singular candle, creating an imbalance on the downside. It reverts right back to that old low here and digs into a little bit there. So in other words, this candle opens, it immediately rebalances all of this range all the way back to the previous candle here, and then drops. Same thing here, we have another imbalance, large down candle. Next candle opens, immediate rebalance back to the old low on this candle there, then accelerates and attacks that old low that we've been looking for months. It took forever to get here. So beautiful to see that. 15-minute time frame. Midnight candle, New York time. We break down, consolidate, we break lower, and then going into New York, we have a return back to a mitigation block right there. Last up close candle, the big beefiest one. And using that low, extend it out in time. That's what this level is here. And if you look at where we had the change in the state of delivery, this set of two candles up, that right there is your bearish order block. The opening price, once we go below that, that's where the change in the state of delivery is. Goes from bullish to bearish right there on that opening. Anchor that down to your low. Optimal trade entry, 79, 62 respectively. Extend that out in time. Bam, hammers it. Now, if you look real close, this price is 1.16588. This high here should show on your platform 1.16589. So it only went one pipette above the 79% tracer level, then rolled over. Bearish order block, all these candles consecutively, draw that out. Hits it here, breaks down, small little fair value gap there, hits it, consolidates, and again presses down into the sell side liquidity. Using the change in the state of delivery optimal trade entry in New York, standard deviation -2 on your fib gives you the bodies of the candles in here real close to it. It's real nice to see that reaching below the objective we were looking for anyway, that old low. British pound versus US dollar daily chart. Beautiful. Just Nest T, just taking the plunge. And for anyone that doesn't know what that means, Nest T is tea, obviously, in the States that used to have, in the 80s and the 90s, they used to have these commercials where it would say, Nestea, take the plunge, and they would just fall back into a swimming pool or fall back into the water of some kind. And I used it when I was doing my S&P Mini live room on Merck. It was an internet relay chat room back in the 90s. And whenever we were seeing a move go in our favor, and it was a short, and it plunged like this, I would put in the room, Nestea, exclamation, exclamation. And it just sends back memories whenever I see this type of thing. But it's taken the plunge, and we ran below, obviously a deeper run below this low here, which was anchored to this low and this low. So we really pressed down in on that. We have low resistance liquidity run signatures here with a low and a higher low there. Otherwise, there's nothing in here that I like. I mean, we have a small little bit of business in here that we've already worked into, in my opinion. This, to me, is best case scenario if we completely melt down. And everything that's going on in the UK, I mentioned last night, it's probably going to be factored into this. And maybe everyone's going to see the dollar index as a flight to quality. And I'm saying that with my tongue in cheek, like a safe haven. and all the other foreign currencies could be melting down as a result of that. So could be on our way to a digital dollar, and just a lot of things I said last night are going to be contributing factors. All right, hourly chart, British pound. Again, I mentioned how we went back up in bearish order block right there. We broke down, attacked the sell side liquidity there, and then consolidated, had really no interest in coming back up into even an institutional order flow entry drill. That is extremely bearish. And then we break down, come right back up in. Again, failure to even get a institutional order flow entry drill there as well, and just cascades lower. So really, really heavy on British pound on the 15-minute time frame. Again, straight shot, just melts lower, doesn't give us really anything until we get into this little pocket of sell side imbalance, buy side inefficiency. So there's your first on the 15-minute time frame institutional order flow entry drill, and then breaks and delivers on the downside. We might get a little bit of retracement. I'd like to see that because it would give the algorithm a way of posturing a short-term overbought scenario, and then move lower for anyone that's thinking we've made the low of the week. All right, I mentioned last night that we would talk about the euro pound. And to briefly bring back up my analogy in regards to when you go to a casino and looking at the roulette table, a lot of people think that you can bet on red or black and it's 50-50. It's not. You have the green. And euro pound tends to act like that for Forex. And the times that I do get euro or cable wrong in my trades predominantly are linked to this pair. This right here, this is the kryptonite to perfect trading in Forex for me. This is the little fox that spoils the vine for me, okay? The idea is this. When euro pound was trading down in here, we were looking for this. I mentioned how that was likely to occur. And we had relative equal highs here. We did trade down to the order block here. But I felt that, much like we had this here, that we were going to leave this intact and then go for this. But over a long period of time. But obviously central banks felt inclined to send this thing higher, run the buy side liquidity out here. And honestly, they could still very well send this thing up into this. With this relative equal highs in here, that creates a scenario where euro could be a little bit more trickier still. But if we completely wipe out and go right back down in and trade below this candle's high, dig into this order block, I wouldn't see that as coming down in to pick up more buys to go higher. That's not what I would see there. If we completely leave this area here and go down and melt below the opening price of this candle, then I'd resume with the expectation we're going to be making a move down into here. And then that might contribute to a British pound versus US dollar consolidation and further decline on euro dollar. And that would be supported with the euro pound. All right, euro pound on hourly chart. And again, really, I'm just trying to explain how I got it wrong. So that way you can go in and you can annotate the charts as well. But I was looking for a continuation lower. I thought that we would break through all this, and they rammed it completely right up in. And obviously you saw it took out the stop on my initial position. And once that stop was taken out, then once we got to this area, we're in an area of buy side for euro pound. So that means I can expect that the euro can now be allowed to trade lower, even though this is consolidating. When this pair consolidates, that allows trending in euro and cable. But if it's trending, that requires you to understand what pair is going to most likely be moving higher or lower and which one's being held. So when this is going up like this, that's when euro was being in consolidation, wasn't permitted to trade lower, while cable was free falling. And that creates this scenario here. So as good as I am, and I'm saying that with humbleness, I'm not trying to brag, this is the thing that kicks my tail sometimes, where if I don't get a good read on euro pound, and it's usually how I get it wrong. Euro pound will come in and act like the green on the roulette table. So it takes away the 50-50 chances of being right on the right pair with euro or cable. Because I could be bullish on dollar, as I have been, and I could be in the euro trading it short and tell you, like I told you a couple of weeks ago or a couple of days ago into last week, saying that I prefer being short euro dollar. And the better trade ended up being in pound dollar. So how I got that wrong was not reading this correctly. And I can't go back and say, oh, I should have done this, I should have done that. I just did it wrong. So I'm not going to beat myself up about it, and I'm not going to give you the ammunition to do the same thing for yourself. When you get it wrong, identify you did it wrong. Give yourself permission and say, okay, I did that wrong. Don't try to figure out all the tiny little things that led up to you doing it wrong. Acknowledge that you did it wrong and keep moving. You got to keep it moving. If you don't keep yourself moving forward and you stagnate over times when you get it wrong, you'll miss the opportunities like what we saw today, where I actually, earlier in the week, I engaged, and here we have it. Another one shot, one kill, delivered like gangbusters to where I said we expected it to go. But my other trade it got stopped out, but not before taking out a large portion of pips that I would normally take in anyway. So perfection is a pursuit of excellence. It's not a destination. You're never going to arrive at perfection. 15-minute time frame on, again, euro pound. Just running right out like that. This is a manipulation right from the central bank. Okay, and this is what it looks like. You can't stand in front of that, and it's just unavoidable. Let's put it that way. And it's going to happen again to me, and it's certainly going to happen to you. So just don't read more into it, and just expect everything to go back into normal delivery once these events take place. If your analysis is correct on the higher time frame, this is just going to be a short-term little blip that's meant to disrupt you, distract you, and cause confusion and make you afraid to go back in and trust your higher time frame analysis. You see clearly that I worked with the same account. I did the same thing, looking for the analysis going lower in euro, and then here we are, despite all this being in the marketplace for euro pound. All right, we are at the homework segment of today's video, and the homework assignment I gave you was the NASDAQ futures for December 2021 contract. That's here, and again, the symbol you put in TradingView would be this, NQZ2021, and you want to be looking at this high to this low, and I gave you as much as this low also if you want to go at far. And if you haven't done the homework yet, by breaking all this down, don't watch the rest of this video. Stop the video, go do that, and then come back. Otherwise, you're cheating yourself from the opportunity. All right, so we are looking at the December 2021 NASDAQ futures contract. This is a commodity market, and this is that high, and you should have the bearish order block, the opening price right there extended out. Now you could have the low and the opening price, and then consequent encroachment noted there. There would be nothing inherently wrong about that, but we're just getting right to the nuts and bolts with it. Trades up into that. Now also you should have this volume imbalance noted, and notice where the bodies of the candles go, right into that area there, and this runs up into the bearish order block. This is a stop running event for this high, and this high. They ran that out into the bearish order block after the bulk of the volume that's visualized by the bodies of the candles here, trading up into that volume imbalance, and then the run for liquidity into the bearish order block. Premium array, high, low, premium, fair value gap, bearish order block, trades down in. Now look at this low. We have the actual low, which is going to be a dashed line, and a dotted line, which is consequent encroachment of this candle's tail. So from the close to the low, we're measuring 50% of that. So you would anchor your fib to that closing price, to that low. The 50% level, you would note that and extend it out in time. You can see we traded to that level today, just a little bit above that. But nonetheless, the old low, and then I said if you wanted to look at this low too, you can factor that in as well, but we anchored it to this for the initial study. So this high and this candle's low. This is today's trading. We'll take a look at that when we drop in the lower time frames. On the hourly chart, NASDAQ futures, you can see we traded up into that bearish order block there. If you look real close, we have a high, low, higher high, and I should have done a better job of lowering it down, but you can see this on your own chart. This is a bearish breaker. So the low right here, we traded up into that. So we have a bearish order block on the daily chart, bearish breaker on the hourly chart, fair value gap closed in here, and we have buy side liquidity taken there. So when we trade back to a premium array like this, you want to take a look at all that price action right there with the SMT approach of NASDAQ, which is what we're looking at here, the Dow, and the S&P. So you would look at those three to see if you're getting divergence in here. And we'll look at that when we get in the lower time frames. But the market breaks down from here. We have a high, low, higher high, bearish breaker. The market breaks down below that, comes right back up in, bearish breaker, consolidates a little bit, and then accelerates. Attacks the sell side liquidity over here, comes back up in, breaks aggressive again, taking the sell side liquidity below that old low, consolidates and trades right back up in for today's trading into the daily candle that makes this low here. This is that consequent encroachment of the tail. So this is the low of that old daily low, and then it had a wick or a tail. And midway point, I told you to put the Fibonacci on to measure it. That's that dotted line I said before we drop down into the hourly chart. That consequent encroachment level is what is being hit right there. At the same time, look close, sell side imbalance, buy side inefficiency. Look at the bodies respecting the imbalance closed with this low. Beautiful delivery. Imbalance, rebalance, consequent encroachment on the higher time frame, optimal trade entry there, sell side liquidity here, bam. From here to here, that is an absolute no-brainer trade for trading index futures. On the 50-minute time frame, right in here, again, you can see basically relative equal highs. We'll get into that when we look at the S&P studies. Small little imbalance here with the breaker. Trades up into that, rebalances that, breaks down, and slides. This in here, you might want to look at that for SMT purposes. I don't recall having that mentioned in this portion of the homework review, but study your SMT divergence between the Dow, the NASDAQ, and S&P futures relating the line chart. In other words, you wouldn't be looking at the candlesticks. Plot it on a line and plot the line chart on the highs and look at this area in here, and you'll most likely get an SMT divergence. I'd be surprised if you didn't. Let's put it that way. All right, and it breaks down, consolidates around the old low, digs back up into the consequent encroachment, which is again that midpoint of that old daily low tail, breaks down, optimal trade entry, and then attacks the sell side liquidity, resting below these really clear, easy, obvious equal lows. Beautiful. It comes back right back up into the imbalance here, rebalances. I would expect it to sell off more. I would like to see it get below this low here, and obviously from there, we'll have to see what we get. But from up here down to here, or even just below this low here, that's just a beautiful run on index futures. And again, during a time when, seasonally speaking, they're bearish. All right, let's look at that area here. Okay, this is that bearish order block and the breaker on the hourly chart. And that's what this area is here again. We go back up to the charts, you can see. All we're doing is taking this candlestick chart and then turning it into a line chart and then hitting the compare tab on TradingView and adding ESZ2021 for the S&P futures. And then you're clicking on the chart and turning it into a line chart plotted on the high. And doing the same thing, adding the compare tab, putting in YMZ2021 for the Dow futures for December contract, and changing this line in the settings by clicking on the actual line and setting it to line plotted on the high. And if you look real close, we have basically a flat almost equal high here. And we have slightly higher high, slightly higher high. On the candlestick chart, you can see a little bit better. I adopted this one so that way you can really get a better depiction of what I'm showing you in that divergence. So at the bearish order block and bearish hourly breaker on NASDAQ futures, we have the high and equal high. On the Dow, we have the same high that's respected here, here, standing out in time. We went higher here, where we did not go higher there. Same high here, and we went higher here. So even the S&P higher, Dow futures higher, NASDAQ not higher. Which one of the three index futures is the weaker? The one that fails to make a higher high. So does it go lower? Yes. Does it go lower more efficiently? Well, look at it. From that high, it went lower, right? They all dropped, but look what the Dow did. Whoop, one more time to knock out those individuals. You don't get that big hiccup higher because this is underlyingly more weak in comparison across the spectrum of all of the three averages. Okay, so one more element of index futures, just working out like gangbusters. And this is a 5-minute chart, so that way you can understand what you're looking at here. In case you didn't notice, I didn't mention it earlier, I'm sorry. But I dropped down to a 5-minute chart so you can see. But you can still see the same clear divergence on the 15-minute time frame. You don't need a 5-minute chart, but I like looking at the 5-minute chart because I'm a short-term trader. All right, tonight's homework for Thursday's review is going to be in the crude oil market. This is the November contract for 2021. And the way you would pull that up in the TradingView browser, you put in CLX for November 2021. You're going to be looking at this high here and this low right there. So we're going to be framing this here for our case study for tomorrow's review. And until I talk to you then, be safe.